Okay, well, welcome everyone. Good morning. I'm Jeff McIntyre, and I'm a business advisor with MMP, and I have a specific focus on the craft beverage industry within my practice here in Kelowna. I'm delighted once again to welcome everybody. Needless to say, when we were planning the third annual Fortify Conference, we never would have imagined this time last year when we were in Penticton that this year I would be speaking to you all distributed from across Canada from my office here in Kelowna. 2020 has been nothing if not memorable, and it seems we are not done yet with 2020, much as we would like to be. Thank you all for joining us virtually today and supporting an event that has become so important to this industry. Maybe the best thing we can say is that we are getting through this together, and we're still standing. We're thankful for that, and at the same time, we feel for those who have suffered this year, either financially, personally, or both. These aren't easy days. So here we are. Well, we're here, there, and everywhere anyway. I'm happy to share with you that this year we built on the success of last year's event, which had excellent sector support from delegates, sponsors, exhibitors, and volunteers. And we're here this year to bring you yet another great event. We've done this while staying true to our roots and showing persistence, adaptability, and maybe even a bit of crazy risk-taking to take a leap of faith with a virtual event. Earlier this year, back in early May, the Fortify planning team met and had to make a decision about 2020. Should we cancel the event, as many other organizations have done this year? Did we want to hedge our bets that COVID would be all over by November and we could plan an in-person Fortify as we always had? Or do we want to hold our collective breath and dive into this brave new world and plan our first ever virtual Fortify? Well, here we are, all separated and safe, but connected through this important event. And thank you for coming along with us. My firm, MMP, are honored to be the foundational sponsors of this Fortify Conference, along with partners Farm Credit Canada. The annual Fortify Conference and Trade Show brings together BC cideries, breweries, distilleries, and wineries for a day of learning, sharing, and networking. It is the similarities across these sectors that drive our conference planning and how we curate our trade show lineup. All of you face marketing and human resource challenges, financial issues, and regulatory requirements, just to name a few, but I think we'd all agree that this sector is stronger when we work together and learn from each other. That, in a nutshell, is the core concept of Fortify: strength in numbers, sharing and leveraging experiences and best practices from each other. It is also what helps us get through these challenging and uncertain times. So before we get started on what promises to be another valuable and interesting day, I have a few housekeeping issues to cover off. Most importantly, please visit and use all aspects of the Fortify virtual portal, including the networking and chat options. That'll just make this day a little bit closer to what we would have seen had we all been able to join together. Please visit the Fortify Trade Show under the Exhibit Hall tab. We owe a debt of gratitude to these exhibitors who pivoted with us and came along for this virtual ride. The booths are open all day and will be staffed for chats and other interactions, so please take time to visit them when you have a break. All of these sessions will start at their scheduled time, so please do not log in late. And I can't tell you where your particular coffee machine or washroom are. You're on your own for that, but I do promise that the agenda will include enough breaks. And finally, if you are having a great day, spread the love on social media. We're using hashtag Fortify 2020. I'd also like to take a moment to thank our sponsors who have made this event possible. In a financially challenging year, these organizations rose to the occasion, and their financial support and contributions are greatly appreciated. Our sponsors for Fortify 2020, in addition to MNP and FCC, are Diamond sponsor Valley First, a division of First West Credit Union. Gold sponsors Ferris LLP, Orchard and Vine Magazine, Great Little Box Company, the Agri-Food Analytics Lab at Dalhousie University, and Canada Post Corporation. Next, I'd like to acknowledge our speakers. We would be remiss if we did not acknowledge them and our wonderful lineup, many of whom have volunteered their time to participate today and who have come to share their experience, knowledge, and expertise from across Canada and the United States. So thank you to Adrienne Stillman, Ashley Komarek, Dr. Savan Charlevoix, Edward Olson, Greg Classen, James Grant, JP Gervais, Karen Graham, Kelly Garrett, Camille Garajwala. Camille, I hope I got your name right. I don't think I did, but I did my best, and you'll be on the panel soon to correct me. Marie Lou Needle, Mark Hicken, and Shawnee Love. And also we'd like to acknowledge our two pre-event speakers, Ian Tostenson and Ingrid Jarrett. Next, our trade show exhibitors. These folks have a vested interest in our businesses and are here with us virtually today from BC in the United States. Like I previously mentioned, please take time to visit them at the trade show. All exhibitor information is listed in the Exhibit Hall tab on the left bar of your portal screen. And finally, our planning committee, who worked tirelessly again this year to bring you an event that's bigger and better. I was pleased once again to work with the following individuals. Al Hudick from Ferris LLP, Karen Graham from MMP, and Karen Graham from Wine Drops. And yes, you heard that right. We have two Karen Grahams on our organizing committee. That's not confusing at all. Sandra and Ken Oldfield from Elysian Products and the Business Alliance for Artisan Fermenters and Distillers, and Carolyn McLaren, Business Alliance for Artisan Fermenters and Distillers as well. And I also want to thank in particular Sandra and Carolyn once again this year, who have been driving forces responsible for putting Fortify together. In light of where we've been and still are this year, it would have been really easy to call it a day and say, no conference this year, we'll try it again in 2021. That thought never crossed their minds, and they were actively exploring virtual platform options way back in early May, I can say long before it became a thing this year. Their thought right from the start was that our industry needs this conference this year, maybe more so than any other year, and we'll find a way to deliver it to them no matter what. So from all of us, thank you, Sandra and Carolyn. Finally, I hope you all enjoy your day, and thank you again for participating in Fortify 2020. We're hopeful that we will be able to meet in person again on November 16th, 2021, and you can mark that on your calendars. We've set that date, and I, for one, feel pretty optimistic that we're going to be able to do that again, and we'll be through this and out the other side. So with that, I'd like to welcome Sandra Oldfield and turn it over to her.
All right, thanks so much. Just a few other things. Thanks so much, Jeff. I mean, MMP and FCC have been really big supporters of us since we started this 3 years ago, and we couldn't have done it without your help. And of course, to all the attendees this year who are braving a full day of Zoom, basically online portals. I think you will survive it and possibly be able to do a bunch of things that you can't do when we're together. So take advantage of that, like, be in comfortable pajamas, a little bit of day drinking is totally okay on this conference. So turns out when you're together, you can't do things like that. So enjoy. I wanted to give everybody just a quick tip. We will be making all the conference materials available to you after the conference is over on the website, but some of you will forget and you'll want to see things quicker than when we get it up on there. So I really recommend that you take your handy dandy little phone, and if a slide comes up that you think is something that you want to remember, or it's too complicated and you want to look at it later in a better light, just go ahead and take a quick shot of your screen with your phone. I think it's a great way to keep content close by. So we're a little bit early, but I think we're okay with that. We're going to get started on the morning panel. And before I bring in the panelists, I just wanted to let you know that we've almost hit every time zone in North America with this panel. So it's amazing that they all can figure out when and where to be and at what time. So kudos to all of them. And the way it's going to work is I will introduce a speaker, they'll give their presentation, and then we'll move on to the next one. So all 4 speakers are going to speak one after the other, and then at the end we'll have time for questions. So make sure that you are putting any of the questions that you need into the chat panel, and I will make sure that they're forwarded to them at the end of this presentation. We got plenty of time for questions at the end. So I'm going to start first with JP Gervais. He's the Vice President and Chief Agricultural Economist at FCC, which is Farm Credit Canada. He's an analyst for domestic and international agricultural policies and markets. And today we're hoping that he helps to set the stage on what we should expect economically into the future. So JP, I will stop talking and you.
Okay, well, good morning, everybody, and thanks, Sandra and Jeff. It's really a pleasure to be with you this morning and with you all this morning, and then sharing our assessment of the economy, as well as, mostly what it means for agri-food supply chains, with an emphasis on beverages as well. So think of this, I'm thrilled to be here, but I'm going to get started right away, because think of this as a rapid fire of economic issues or economic trends, because it's got about 15 minutes. We got a great session, 4 speakers, and we want to make sure that we leave some time for Q&A. So if I am looking at my watch, you'll know that it's just to be respectful of the time, and I'm going to make sure to stick to my 15-minute and then pass it over to the other great speakers as well that we have on the program. So if I get started, I mean, the one thing I want to emphasize is I'm going to spend just a little bit of time going back over the last few months, but really at some point we want to make sure that, or I want to make sure that I address as well what is on the horizon, right? At the outset of this economic crisis, it quickly became an alphabet soup of economic type recoveries, right? So there's this idea that, as the first wave of COVID hit, that we were putting ourselves in a lockdown, in a recession, and the discussion quickly emerges to what type of recovery we were going to be witnessing, right? So it's either a V-type recovery where you close down shops and a lot of different businesses and so forth, and then creates this big drop in economic activity, and then you open up real quickly, you get this rebound. Discussion around, the pace of the rebound. Is that going to be something quick? Or is that going to be something that you'll drag over time, which is sort of the U-type recovery? Is the idea early on as well that there was going to be a W-type recovery where, a second wave hit, which is really what we're currently witnessing right now. As the second hit, or as the second wave hit, are we going to see another decline after the little bit of recovery that we had towards the end of the summer? And really as well, all the government support, monetary, fiscal support as well, that we witnessed at the outset of the crisis, well, all of that at the end of the day had the objective to avoid what we call an L-type recession, where businesses and households put themselves in a situation just because of the economic conditions that create a permanent gap in economic output, right? So the idea that you're still growing, but you're growing at a much slower pace and on a lower trend than what was planned at the beginning of the year. But then now what has emerged is sort of this K. So believe it or not, another letter, K-type recovery, right? So part of the K it's pointing upward, meaning that there's a segment of consumers or households, as well as a segment of businesses that are doing okay in this environment, and another segment with the part of the key that's pointing downward that is not doing well financially and from an economic standpoint. So this is the picture on the left-hand side, what's going on in the world. Most recent data or forecast from the Bank of Canada. Interestingly enough, the bank has always had a reputation of being too optimistic. And when you look at their 2020 forecast, which is the red bar at minus 5.7%, this is actually a little bit too negative in my head. I'm still fairly confident we can get by the end of the year minus 5%. The bottom line, though, is a couple of things, right? On the right-hand side, you're looking at the pace of recovery that is slowing down, right? This huge drop month to month, in March and April, then growth again. But I think the key lesson here, or the key point, is that by the end of 2021, the indications that we have right now and the data that we have suggest that we're not going to be able to be at the end of 2021 where we were prior to the start of this crisis. So at the end, let's say at the end of 2019. So think that beginning of 2020, end of 2019, fast forward to the end of 2021, with the numbers you're seeing up on the screen, that's not going to get us back to where we were. So by the end of 2021. So it's actually a pretty strong statement, right? To think that, the crisis is not going to be resolved from an economic standpoint, fully and entirely resolved by then. The thing is that, it looks as if perhaps that's not too positive. The thing is, with any type of recovery like this, the early stages are a lot more significant and happen faster than the last few percentage points that are needed to get back to where you were at the beginning of the crisis. So I do expect that we're going to see a lot more hardship, or that some businesses, again, it's a key type recovery, right? So that segment of businesses is not going to necessarily get out of the recession and get out of the economic crisis in a good spot. Now, if you think of the agri-food supply chain, so this is GDP, August to August, so most recent data points. And so for different segments of the supply chain, you look at wineries and distilleries, I'll say a little bit more about that. But GDP is really just a big proxy for economists like myself to think of net income or profits, right? So it's not the same, I get it. But it's a proxy, right? Profits, GDP, that correlates usually very well. It's not a perfect measure for sure. At the end of the day, business owners, care about what's left in their pockets, rightfully so. But this is a pretty good proxy as well for sort of the spread and distribution of economic impact throughout the supply chain. And you see on the far right, no surprises there. Obviously, services, when food and drinking places as well in terms of GDP are continuing to hurt, and things are not maybe not improving fast enough, especially considering that we're in the middle of that second wave. Now, you're saying, all right, this is all backward looking. Well, some of it is backward looking. So what about the future? What are the things that we need to monitor going forward? So I'm going to focus on a few different financial and economic variables. And one is interest rates. So this is a picture of what we call yield curves. And it's really an idea that something that we use to understand how markets are looking at the future. You're seeing a pretty flat yield curve right now. So that's at the beginning of the year. So if you see the date on the top left corner, January 2nd, 2020. So at the beginning of the year, the expectations for economic growth, there was still an expectation of growing as an economy. That wasn't really significant, right? Flat yield curve, especially when you look at Canada. The US was looking up a little bit more than in Canada, but the outlook was for growth, but minimal growth, right? So under the what I would call the normal growth rate, certainly in Canada. And then what I'm going to start, and hopefully the technology works for me, because in a minute this is going to be an animation. So you'll see the date, fast forward to where all the way up to the end of October, I believe, or maybe even into November. But you'll see this yield curve at one point in March drop significantly, bringing borrowing costs or interest rates down. And you'll see where we are. So I'm just starting the animation now, and it looks as if it's working. And so you see that yield curve at one point being sloping downward, meaning that the market was expecting that we were going to get into trouble. Then the Bank of Canada goes in, lower the overnight rate. And what you're seeing, so what we're looking at is any sign that the markets, we're towards the end of August now, any sign that the market would believe that the economy would resume growth on a steady path. So I'm just going to stop this because this is just, again, and I don't know if you were able to notice, but there was no noticeable sign of the markets believing that we were going to be able to grow on a steady path again in a foreseeable future. Now, thing is, as a working for a financial institution, the one questions that we get all the time is that, what are we supposed to do with interest rates, right? The idea that interest rates are quite low right now. If you look at short-term rates, it's almost at a record level in terms of historically low record in terms of the short-term rates. But of course, the flip side of that is that there's also a pretty good opportunity to lock in some very decent long-term rates. And there's a reason why long-term rates are where they are. It's because the likelihood of seeing short-term rates mostly controlled by the Bank of Canada go up is actually very low. That likelihood of seeing the Bank of Canada raise interest rates is very low. Don't believe that this is going to happen before sometime in 2022. And as a result, markets are pushing the long-term rates as well down. This is also for sure driven by the actions of the Bank of Canada. If you look at what the Bank of Canada has done during this crisis and compare that to what they've done, let's say during the financial crisis of 2008 and 09, there's been a record amount of liquidity injected in the economy. In fact, controlling for size, obviously the size of the central bank in Canada is not like the size of the US Federal Reserve. I get that, but controlling for size, the Bank of Canada during this crisis has been the most aggressive of all the Western banks. Or the central banks of the Western economies. And so that says a lot about the amount of liquidity that was injected with the objective of bringing those long-term rates down. Don't expect these to come up anytime soon, but I do think that there's a great opportunity for businesses to think about the long term, lock in some interest rates for the longer term, given the historically low interest rates that we have in the marketplace. Another thing to notice is that Canadian households throughout the crisis have brought down their debt to income ratio from 175% to 158. Savings went up during the crisis, and some segments of consumers, not everybody obviously, because I said it's a two-tier recovery or a two-tier crisis that we have right now. There's a segment of households that have lost their jobs, have not been able to gain back employment, so we have to be mindful of that as well. But in the aggregate, we do have consumers that have brought down debt as a function of income to 158. So actually, it's a pretty good news story. You'd like to see that ratio a little bit lower for sure. But going from 175 about 3 months ago, last time we had the statistic, and then to 158 right now, it's a pretty big achievement. And I would say there's some sort of an argument for pent-up demand once the economy reopens. Now, obviously, the labor market, reached a high unemployment rate at the height of the crisis was north of 13%, I believe, for BC and across the country. We're in that 8% range in BC, doing a little bit better than everywhere else. But again, it's still I would emphasize that the last few percentage points in bringing down the unemployment rate probably going to be the hardest to get to. And then businesses are still struggling in a lot of different ways to find qualified labor. So that's something to keep on the radar. And I just don't know that the labor market is going to move in a favorable direction too fast, considering where we're at in terms of the second wave of the virus, as well as the fact that those last few percentage points before getting back to where we were probably going to get the hardest, be the hardest to get to. As well, one of the things to keep in mind going forward is the fiscal situation in Canada. We are going to be, we're looking at a record deficit to GDP. So that's the chart on the left-hand side. You see the 2021 fiscal year. We're looking at 15%. Some of those numbers don't even account for some of the measures that have been announced post September 1st. So it's not a stretch to think that this is going to be even larger than what you're seeing up on the screen. And of course, running this large of a deficit has an impact on the right-hand side when you see debt to GDP, our debt to GDP ratio go up to 47%. Nowhere near the high of the mid-90s. And the piece of good news as well is that if you look at the blue line, that's debt service ratio from a government standpoint is still projected to be down. But that's a function of the low interest rates that I was talking about, right? So if that outlook was to change, not sure that it's going to change anytime soon, but if that outlook were to change, then obviously that would change the picture. And I would say one of the things as well, because one of the things that we hear from our clients is just what is the outlook from a fiscal standpoint? And it's really hard for me to think of a situation of bringing this deficit down, debt under control, or more towards more where we were prior to the crisis without raising revenues. I don't think this can be done only on the expense side. So I think raising revenues is a definite possibility. I would say that would suggest that governments perhaps are not at that point yet to think about this, but certainly in the long run, I do think that this is going to be something to think about. Real fast, I got about 3-4 minutes left here. So currencies, they matter a great deal for sure. You know, sometimes it matters for the inputs that you buy. And so I'm always reluctant to say, well, a low Canadian dollar is good or a low Canadian dollar is bad. It really depends on the perspective you have as an exporter, obviously. The dollar being as low as possible makes it a good thing. But if you're purchasing a lot of inputs, that's the reasons why as well. Sometimes I include the euro to Canadian dollar exchange rate, because in the beverage industry, we do import some equipment from Europe, which matters a great deal when it comes to the exchange rate and the price you pay for that equipment. Don't expect our Canadian dollar to gain value against the euro anytime soon, unless we find a situation in Europe when it comes to COVID-19 and the pandemic gets worse than it really is now. Things are pretty bad already. So I just don't know that I would expect the euro to decline further than what it is against our currency. And really, when you think of the Canadian dollar and the US dollar, which is the red line, it really is driven by the appreciation in the US dollar, less so than the depreciation, so the decline in the US dollar. So if you think from April to July, August, and you see the red line go up, it's more the decline in the US dollar than any type of appreciation of the Canadian dollar that is reflected in the line there. Manufacturing shipments in BC, just a few statistics there, just to make sure that, I do point out that, for wineries, got a really strong month of August, but as well as March and April that were good months prior to the previous year. So if you look at the March to August of 2020 relative to the March of August to 2019, this is where you're seeing a bit of growth. Breweries, it's a bit of a different story. Despite a strong July, the March, April were not as good, and hence the reason why we're seeing. Another thing to keep track of, a monthly receipt from drinking places, but I'm going to skip this real fast. Other than say that, if you look at the red bar, which is BC stats, and you look at receipts, that 24% decline matches up actually to one of the stats that we track when it comes to demand or potential demand downstream in a lot of the different markets, which is the retail traffic, right? So if you look at retail and recreation, groceries, parks, transit, so that's traffic according to Google mobility data points or data sets. You got the Canadian data point, most recent data point relative to the baseline in January and February. And you also have the trend, and you see that's trending slightly down. But again, if you look at the receipts at the food retail or food service standpoint on the previous slide at -24, it matches up traffic really well here, right? If you look at retail and recreation being down 24%. Is that going to improve anytime soon? Well, a lot of it depends on the pace at which we're going to be able to open up economies. And I would say that would be my number one feature to monitor, obviously, on top of the economic variables that I was able to point out that have an impact on the bottom line of businesses. So on these this conclusion, Sandra, I would turn it over to you. Stop sharing my screen and for you to introduce the next speaker.
All right, thanks so much, JP. It's nothing like getting a bunch of data before 9 a.m. So thank you. That was awesome. And again, a reminder to people, I'm making notes of your questions and we'll ask them at the end. So still feel free to put them into the chat. Our next speaker is Komil Gajrawala. He's a managing director covering the beverage and household and personal care products sectors at Credit Suisse. And he comes to us today from New Jersey. He always has a great background. So thank you for bringing your good art today, Komil. And
my pleasure.
Komil focuses on the consumer sectors and is a top beverage analyst. So Komil, I have to tell you, you were the last name I had in my mind before I went to bed last night and the first name I had this morning. So thanks for making such a big impression on me.
Well, my pleasure. Happy to help. Good morning, everybody. So our message really today is the degree to which we're moving kind of faster to the future. I am, as Sandra mentioned, I'm the U.S. beverage analyst. And you know, I will talk about kind of some things globally, but we spend more of our time in the U.S. Hopefully some of what we outlined will be useful to you folks in terms of what we're seeing in the market and how they may relate to Canada and to BC. My role is I'm a securities analyst. What does that mean? Effectively provide investment advice to institutional investors. These would be the pension funds, mutual funds, hedge funds, different funds that manage wealth of general people. And we try to just be experts at what we do. My space is consumer products and wellness. That means we must consider macro, we must consider regulatory, then we consider competitive dynamics, all these types of things. The goal really is to be accurate, not to be right, and to be able to provide kind of a detailed analysis of where we are and where we think we're going. So in that, starting with the economy, we'll keep this brief because obviously you've been provided a good kind of summary of the economy. A couple of things I wanted to highlight in terms of what was happening in the United States is the degree to which, you can see the red bars, the degree to which unemployment impacted the lower income strata of the economy. And that's critically important because of course there are ones with much less of a cushion, and you could see almost 20% of the job losses were in that, a 20% decline in employment for that strata. Now on top, you see the blue lines. That's why our stimulus was very largely targeted to that group. In fact, looking at this next slide here, you'll see that disposable income for the United States over the course of this summer increased through the pandemic, did not decrease, they increased. Of course, income from jobs and wages declined, but income, when you include stimulus and you include unemployment assistance, actually increased. And that led to something that probably none of us would have expected, which is there was a higher savings rate over the course of this summer through the pandemic, something that really wouldn't have ever been part of the plan. It didn't mean the consumer didn't spend, but it does mean that they didn't spend at the rate at which disposable income changed. And if I were to just summarize kind of how we're thinking about the consumer environment, is we are not seeing any recessionary behavior tied to unemployment yet. Now that can be because of stimulus. It's likely to be because of stimulus and some of these other sorts of things. But the reality is so far we're not seeing that. The other thing is if you're going into an economic crisis, there is typically a credit crisis involved, and we're not seeing any credit crisis. We're not seeing any kind of liquidity issues. As we just kind of talked about, interest rates remain low. Taxes, the moment, remain low. That could change. Obviously, we've had an administration change, so that may change. But at least at this moment, we do have lower taxes. And we may be making it, we don't know for sure. Obviously, we're going into a second wave, which in many ways was expected, but we may be getting to escape velocity where the effects of stimulus did temporarily help us cushion the blow to the point where we might be moving towards exit velocity, and we may not feel as much pain as I know has been discussed in the media in a lot of detail. Let's talk about the consumers. I'm a consumer analyst. Not shockingly, this chart here shows you that almost 90% of consumers at the beginning of the pandemic said COVID has very materially impacted their behavior. It's gone from 90% to 80% if you look at kind of more recent numbers, which I think shows that the world, it doesn't mean we've solved this issue, but you can see that we're starting to learn how to live with it. The consumer has also very fundamentally changed what they're spending money on. That dotted red line is out of home spend. The blue line is hard line, broad line, and food retail. So there is this shift from food away from home, out of home spending. some of that is getting reallocated to the different segments of the market. In fact, some particular thing, Yeti sales accelerated up 30%. They were running at a rate of up 20. Peloton sales absolutely off the charts. Good luck trying to get one. If you want to buy one, there's at least a 3-month wait. Restoration hardware, $10,000 couches growing at a rate of in the 20s, now in the 40s. This is their monthly demand. Obviously, these are all kind of high end. Those are high end offerings, but the reality is the spending is there. The spending has just shifted, particularly when you look at Yeti, but also when you're thinking about things like pet ownership, which has absolutely spiked. And pet ownership comes with, especially in the first few years of pet ownership, the spending behind pet has expanded very substantially in recent time. And so if we think about some of the big shifts is, one, the consumer has shifted their spending into their home. They've invested in their home. They've been entertaining in their home because they have to, but that may continue for a period of time given how much money they've spent on expanding some of these sorts of things. And again, we're seeing it across high-end and low-end consumer. Now, this is an important quote. The most relevant consumer trend to dominate the next 10 years is cocooning. This was from a friend of mine, Harry Shoemaker, which is the idea of just staying home. In fact, if you look, here's a survey of adult millennials, 72% agree completely or somewhat agree that they prefer to stay home than go out at night, versus only 28% that disagree. 47% of Gen Zers, I know there's so much conversation about millennials. Millennials are getting older now, the Gen Zers. 47% of them watch 3 or more hours of YouTube per day. And YouTube, Netflix, that is changing of how they're consuming content. There's also a changing of behavior when you think about social media. Social media consumption has gone from 1 hour and 30 minutes in 2012 to now it is 2 hours and 23 minutes during this period of time. So you're seeing this very rapid increase. I like this quote from Vice: "Young people are the new old people." This is not something I think anybody, particularly in the beverage alcohol world, would have anticipated. But when we compare millennials to Gen Zs, Gen Z is watching a lot more TV than the millennials by almost double. Hours on social media, still almost double Gen Z versus millennials, kind of showing, I think, an important trend. And I think the most important and critical thing when I bring up each of these things is, if you think about cocooning, watching TV, prefer to stay home, use of social media, that sort of thing, all of these numbers that I showed you, all of these things are either surveys, statistics, commentary, publications, media quotes, whatever they are, that all came pre-pandemic. So it feels like these were the sorts of things that would happen because of a pandemic. This was all happening anyway, which gets us to our kind of faster to the future point. Also true in many ways for restaurants. Over the last kind of the expectations from the National Restaurant Association, 5 to 10 years, 50% of sales will come from takeout. Digital ordering to go from 12% from what was around kind of 2%. Delivery, same sort of thing, increasing very substantially, particularly from limited service restaurants, which would be basically QSR, quick service. All forecasts, all expectations of things that happened pre-pandemic. All of these goals, expectations, forecasts probably have to be shifted to the upside, given this is a trend that was happening, but COVID accelerated each of them, including grocery sales. Online grocery was expected to double from about 14 billion to 30 billion, led by Amazon and Walmart. Grocery Dive expected a very big increase to 100 billion by 2024. Give you some context, particularly why it's important, I think, for the US and Canada, is that we actually under index in digital sales for online groceries. A couple reasons for that when you compare us to some of the other kind of rich countries that you see here, is that we're a little bit broader geographically. But the reality is, if you look at some of these markets like China, Japan, UK, there's very substantially more spending on online grocery. And these numbers that I was showing you, the actual figures are 2018 figures. The 2023 estimates, again, this is another survey that came from pre-COVID. So while there were expectations for doubling, expectations for tripling, comparisons to how far behind the US and Canada were to the rest of the world and why online grocery should grow faster. All of these things that I'm showing you are things that happened or were brought up really pre-COVID and just accelerated. So there's a lot of conversation about how much things are changing. And of course, some things have changed permanently. But I think it's more important to focus on the acceleration of things that were already happening, whether it was how we're all working and communicating, including right now, right this second, or whether it's how we're shopping for items like obviously beverage alcohol, where if you looked at the funding of some of these things like Minibar, Drizzly, Shipped, these things were raising more and more money, more and more capital, and growing their businesses at a very, very substantial clip before we went into COVID. We went into COVID, I think many of them unfortunately felt like they were kind of on their back feet. They wished they could have been further along and more prepared and had to scramble in order to get there. So now talking a bit about beverage alcohol and where we are to beverage alcohol, the way we like to think about it is we were shocked, not something we would have predicted accurately, but the consumer's ability to almost seamlessly shift from the bars to their backyards. We did not see a very meaningful dip in overall consumption of beverage alcohol, even though there's exactly the sort of thing that we all should have expected, given 20% of sales of beer, for example, are on premise or on trade. The winners were a little bit different than one might expect. So you did have a lot of growth in kind of some new brands, a new category in the case of beer, new brands in the case of wine. But where I find spirits to be interesting comparatively to wine and to beer, that it was actually more of the traditional brands that took off in terms of being the fastest growing, as opposed to when you look at beer, it's some of the newer brands and really biggest players in the newer category, which I'll talk about momentarily. It doesn't mean there's not going to be weak spots, and I think that's something we're going to have to think about meaningfully. What's true in New York, I think is true of all the major cities, is that many of these restaurants were already operating on such razor-thin margins, and everybody's guess is a guess, but we're hearing anywhere from 2/3 to 3/4 of all restaurants may go away and close permanently by January. Now, that doesn't necessarily mean they're gone forever. There'll probably be a reemergence. One of the things that we find in these crises is they operate a little bit like a forest fire. They clear a lot of the underbrush and a lot healthier industry starts to grow. But at the moment where we are is we're still clearing a lot of these kind of weaker business models, weaker things. And it's very mom and pop. It's very small business. It's very unfortunate, but it is a reality. The other thing is craft. And craft is somewhere where we're focused very carefully to figure out, what is going to be the future of the craft industry. In the United States, about 50% of craft is on trade. Many of them only sell on trade. They don't have a bottle can business. They sell in draft. They don't have an option to switch people from bars and restaurants to retailers. And unfortunately, there's going to be a big shrinking in the number of players in craft. Now, the applications for new craft beer and breweries and distillers continues to kind of grow. But the reality is, I think we were already going through a period where the massive fragmentation was starting to slow, if not revert. This is going to accelerate that once again, faster to the future, same sort of call. Now, what does this mean with some of these changes, given if we look at the last 2 decades, about as long as I've been in the space, beverage alcohol consumption has been declining marginally, slow rate, but declining. You are seeing some responses that I find interesting, particularly when you have several of the large companies across many different markets around the world, all launching low or no alcohol products. It's very rare to see a Heineken, a Carlsberg, and an Anheuser-Busch InBev all doing the same thing in a category that hasn't really emerged yet. Usually what happens is something like seltzer starts to take off, and then you see the big companies try to get involved in some meaningful way. But the real kind of emergence of a category very rarely comes from the biggest of the companies. Zero alcohol, low alcohol is not something that exists as a kind of large, meaningful category yet, but there's something that they all see collectively that has made this a meaningful part of how they're trying to grow their businesses. And Heineken 0.0 being first has actually shown, I think, all of the market that they were right, that there is a market for this product. It's doing phenomenally well. It's being treated like a beer, and that is being priced as a beer, advertised as a beer, marketed like a beer, as opposed to some kind of low version alternative. And I think in doing that, they found that they've had quite a bit of success. These are some kind of quotes. It's kind of me quoting myself, maybe not so cool, but I thought it was important. It was towards the end of 2019. We were at a beer conference we've gone to for the last 15, 18 years. And a couple of things we saw about beer that I think are different is because beer has been struggling for such a long period of time, it became about efficiency and about pricing and about market share. But what we found at this conference for the first time in many years, it was the Beer Marketers Insights Conference in New York in the fall, is that for the first time there was a big step up in advertising, a big step up in capital expenditures, much more focus on growth. Now, seltzer, I think, is what kicked off the process, but the reality is all this, there's more money going into the business to try to grow, which was in the fall of kind of the pivot point, in my view, was the fall of 2019, as opposed to money going into the business either to consolidate or to be more efficient, which in many ways, my view, led to a lot of the problems in beer. Much of which you can see here on the chart in the left, which is beer has been losing share of total beverage alcohol since 2000, and very substantially. The thing about consumer is things don't happen very quickly. So each year you don't feel it, but when you look over a generation, you realize beer went from having 58% market share of beverage alcohol to what today is 45. Very substantial change. That now might be changing because we include seltzer as part of beer, and that might be shifting this a little bit. Not surprisingly, the data I think looks the same across markets. The spirits has been taking the bulk of that share. About 10 points went to spirits. Wine, interestingly, flattened around 2010 to 2012 period at around 18.5% of the beverage alcohol market, and actually lost quite a substantial amount of share last year. In fact, for wine, 2019 was the first year that was a down year in wine in the last 20 years. That could be because of seltzer. Here are some of the numbers on seltzer. We think it's a real category. We think it's meaningful. These are the sorts of growth rates that investors love to see. You grow 100 million, then 200 million, then 300 million, then 400 million. You don't really know how far it's going to go, but as wild as the growth rates look for seltzer, the market share of seltzer as a percentage of total beverage alcohol is only really around 6.5 share. And I think that's important because if you look at seltzer and where their volume comes from, and this is the bar chart on the right, only about 50% of the share of seltzer comes from beer. It's very kind of evenly split between beer, wine, and spirits, which means seltzer is growing, but taking for the whole of beverage alcohol, which means a 6.5 share. There's a lot of conversation about how seltzer has an 11 share. How big can it get? Particularly when you think of the Bud Light, Miller Lite, Coors Light kind of complex being about a third of the market. The reality is looking at share of beer for seltzer is an inappropriate or an inaccurate way to look at it, given that half of that share comes from outside of beer. So on beverage alcohol, just thinking about it, first major point, it's a resilient category. The consumer really did shift very quickly from on-trade to off-trade, faster than any of us really would have expected. The reality of what the retail market looks like on-trade is yet to be discovered. I think it's going to be some time because we'll go through a period of a clearing mechanism of a lot of small mom and pops, and then a reemergence of exactly that same sort of thing. I think seltzer has reignited investment in the industry, which might help return growth, particularly to beer, which is, again, drove CapEx, drove advertising. Beer has been about efficiency for a while, and I think that's important. Let's talk about recovery and kind of where we are on recovery. I understand all the stuff about second wave, and again, there's many ways to be expected. Here's how we're thinking about it. First is, this is some commentary from Coca-Cola, which was they were down 25% globally in May and June. But pretty much every monthly period subsequent to that, when you're looking at it on a global basis, but also if you're looking at it in very kind of country specifics, was sequentially a little bit better. Still negative. 50% of Coke's business is food away from home. Still negative, but sequentially getting better every single period. Same as to say if you look at restaurants, still negative, still very negative, but sequentially getting a little bit better every single period. Categories that you might not look at, these are all owned by Church & Dwight, a company that I own, but you look at things that you may not think of, but really are good indicators of whether or not population mobility is increasing and people are kind of returning to normal. Things like dry shampoo and water flossers, condoms, all of these things, again, still not positive, but at least recovering from their troughs. We like to look at the market demand for trucking. Of course, the movement of goods is critically important, and we're seeing kind of demand for trucking has started to improve. And the stock market itself as well is kind of started to improve. Now, we kind of stopped at September because it was extremely volatile around the election. In fact, it's kind of spiked since then. But the reality is, if you look at the trend line, the market is feeling a little bit better about the future. So again, to summarize the whole thing is, we're not, as it relates to the consumer, we're not seeing any recessionary behavior across CPG or food retail, and we might be close enough that we get to escape velocity and might be able to get out of this. We should expect some broad changes to how the consumer responds and reacts, but again, those changes are not doing things very structurally or fundamentally differently, but instead it's going to where we were going to go 3 years, 5 years from now, and happening a lot faster. And so really critically important, I think, to embrace that. Keeping in mind kind of disposable income from stimulus, it's been invested back into the home in many ways. And I think the consumer is going to want to kind of extract value of those assets, whether it's patio furniture or fire pits or whatever they've done. There's just going to be more at-home entertaining than there has been in the past. And it's going to happen at the same time where the number of offerings on trade is going to decrease as more and more of them start to kind of go out of business. And so I think we're seeing kind of the early signs, and finally, we're seeing early signs of what could be a recovery. Obviously, there's vaccine news now, timing and deployment and all those things are yet to be seen, but we might be close enough where there's a reasonable amount of cushion in the market to get us through. And that's it. Hope you enjoyed talking to you guys. Here's my contact information. You can email me if you'd like a copy of the presentation or anything. Of course, email Sandra. That's it for me. I'll stop there and pass it on to Savan.
There we go. All right. Thanks so much, Camille. We have some questions for you. We'll keep them to the end. I am taking note of them just so that everybody has that. So our next presenter is Dr. Savan Charlevoix. He's a professor of food distribution and policy at Dalhousie University in Canada, 4 hours away from us, so not breakfast for him. On Twitter, he's known as the Food Professor, so it's at Food Professor if you want to talk to him on Twitter. And his current research interest lies in a broad area of food distribution, security, and safety. He's one of the world's most cited scholars on food supply chain management and food value chains and traceability. So Food Professor, I'm hoping you are in there. Yes, you are.
I am. Yeah. Well, thank you, Sandra. Thank you for the invitation. Whenever I'm asked to speak about wine and beer, I'm absolutely there all the time. So it's a privilege to talk to you guys. I am a little bit pumped actually about the future of this industry. I actually do see great things happening. In fact, you may have seen in the news this morning that both Corona and Stella Artois will now be brewed in Canada. It was actually in the London Free Press because the plant is actually going to be located in London, Ontario. And I want to start there because it is an interesting story. It's about onshoring. It's about local. You can see that really there is this movement towards local much more so than ever before. I know that a lot of microbreweries are suffering out there. And frankly, I think they may have been too many launches in recent years. But I think there's going to be a bright future for local products, local beverages, celebrating what we do in Canada, whether it's in the Okanagan Valley or right here in Nova Scotia or in Ontario. I actually do see that there is a bright future for this particular sector. And in light of what Camille and JP presented, I actually do see economically that there are really conditions that can drive more business in that sector. And I'll build on what JP and Camille have said. I'm not going to repeat what they were saying, and I actually agree with both of them in terms of how they see the landscape. I'm just going to add to it. I don't have any slides. I just want to talk to you guys about what I think is going on. The first thing is context. There's still a lot of nervous people out there. In fact, we, as a lab, we survey Canadians all the time. And if you're interested in having access to any of our reports, you can just go to the Dalhousie University website and just look up Agri-Food Analytics Lab, and you'll find all of our reports. And we've surveyed Canadians on food waste, consumption, e-commerce. I'll talk a lot about e-commerce. We've surveyed Canadians on their perception of the virus and how that virus is impacting their food decisions overall. So lots of data since March that we've collected. And frankly, it's a bit overwhelming, and every week had its different narrative. It's been very difficult to follow what's been going on in the industry. But the anxiety is still there. It remains. 48% of Canadians actually are concerned about food shortages. They're concerned about the virus as well, what it could do to their health. And so they're staying home as much as possible, regardless of numbers, regardless of what's happening with the vaccine story being rolled out right now. A lot of people are just ordering online. And we actually did release a study recently on e-commerce, and I'll get to that in a second. The overall economy, we expect that there's going to be a sandwich phenomena for consumers, a fiscal sandwich phenomena. I see that some questions were related to the debt, and JP actually talked about that and the deficit. Very concerned about that. We haven't talked about how we're going to repay most of the programs that we've seen in recent months, and we'll get there. I'm not sure anyone is ready yet, but at some point we're going to have to be ready. And I actually do see this sector as being a little bit vulnerable to increased taxes. And JP talked about increased revenues. I agree with him 100%. I think that many governments, provincial governments, and the federal government will be looking for opportunities to tax. And whenever there's robust demand, and there's going to be really good demand for your products, I believe, I suspect that the temptation to tax further will be quite substantial, unfortunately. But the demand is going to be there, and also the phenomena we are also seeing is the fact that people are staying home, but they're also telecommuting. We actually released a report in the summer about telecommuting, and I don't think that JP and Camille talked about this phenomena. It's a real phenomena. It is really the one factor that is going to be impacting food service and even food retail to a certain extent over the next little while. 23% of employers, not employees, employers in Canada are actually thinking of allowing their staff to work the majority of the time, not on a full-time basis, but the majority of the time in their homes and not at work in some location downtown. And when you think about that, it really will have a huge impact on how people consume food, how they buy food, and whatnot. And so you have to think as a business owner in wines and the brewery sector, you have to think about how you relate to a consumer that is going to be spending way more time at home consuming the product that you're offering to them. It's going to have a huge impact. People are cooking more, obviously, and people are gardening more as well. So that relationship has changed dramatically. Will it go back to how things were before? Probably not. Of course, a lot of people will go back, will get busy again, will be traveling again at some point. But I think that because COVID has lasted so long, it will have created really new habits, and those habits will likely prevail for a great number of people. The e-commerce phenomena needs to be underscored here. We actually did a survey recently. 8.7% of Canadians have actually bought alcohol online. 8.7% has bought an alcoholic beverage online over the last 6 months. That is a lot of business, and we are expecting that to increase. In fact, when we survey Canadians, we realized that 4.2 million Canadians have actually ordered food online, not only for the first time in their lives in the last 6 months, but they are ordering food online once a week. That virtual world is exploding. And frankly, when you think about the legacy of COVID, we've been talking a lot about this blurring line between service and retail. I actually believe that COVID has blown everything up. There is no line anymore. And you see a lot of things that you didn't see before. Kraft Heinz is now operating a restaurant in the GTA. Loblaws is actually selling meal kits from restaurants delivered to people's homes. Loblaws, the number one grocer, is no longer just a grocer. It is a food broker. So when you think about your business, there are great opportunities. And in fact, in our home here, I think we've had champagne, we've had wines, beers, cider delivered to our home several times since the start of COVID, just because we were either in self-isolation, we didn't feel going out. Deals were pretty good online as well. So people are looking and there are great opportunities there. We are expecting that 49.5% of Canadians will order food online at least once a week after the pandemic. And the reason why we think that, well, there are two arguments there. On the one side, on the supply side, we actually have seen many announcements, over $12 billion worth of investments over the next 5 years, coming from companies looking at increasing their presence virtually. So the horse has left the virtual barn. I mean, more and more companies want to be online and want to be there selling to us, selling to you and I as much as possible. And on the other side, of course, you have human behavior, the fear of COVID, our pursuit for convenience. That's not going to go away. Of course, all that comes at a premium, but food prices are going up, and how you define what a premium looks like will really change over time. We actually do believe that people will spend more money on food and beverage relative to their disposable income. Now, the big question mark that I have is, what does that disposable income look like? Because of that fiscal sandwich we're all going to be facing is really the big question mark. We don't know. But in Canada, we are slowly departing an era of cheap food, which is really significant. Over the last 10 years, if you look at StatsCan's data on inflation, the food inflation rate, the food inflation index has outpaced the general inflation index by 23 points over the last decade. And we're actually releasing Canada's food price report in December, on December 8th, with Guelph, UBC, and the University of Saskatchewan. And let me tell you, the food inflation rate will continue to be quite high relative to the general inflation rate, which means that more and more households will look at food differently, will invest differently, will spend more. And of course, in the middle of that is our wines and beer. Absolutely. And that's, so their criteria, the way they assess food, the way they want to spend on food. Now, don't get me wrong, a lot of people will be impacted by what's going on economically, of course. A lot of people will be left behind, unfortunately. But as Camille said, I mean, there's the bulk of the market is really moving in another direction with less debt. And we've barely seen any changes in behavior as a result of the recession, which is really incredible when you think about it. But it is absolutely true. And pent-up demand on the other side of the pandemic is, I think, a pretty solid argument when you look at the data right now. So the market is completely in transition. And the other thing that I think we all need to keep in mind is that the entire supply chain, regardless what you're selling, is now completely democratized. Doesn't matter what you do, doesn't matter what your business model looks like, you have access to many more channels to get to your money. And that's really the difference between then and now, before COVID and now. Before COVID, you saw Canadians looking at it online. You saw an industry looking at online without without a firm commitment. Let's be honest. In Canada, compared to the US, we were way behind, but we're catching up. The 2017 deal between Whole Foods and Amazon was pretty significant for us in Canada, but it really just got people thinking about e-commerce. COVID just, as Camille said, completely accelerated everything. And we actually expect the volume of sales in Canada to triple online by the end of this year compared to last year. Triple. So if you're not even thinking about online, you absolutely should. I think it's important to think about what's happening there. So a lot of companies are pivoting, which is critical. But the one thing that I would say is that there are two things. One, I would actually say that the local movement, what I would call the will to appropriate food systems, I guess, coming from consumers is real. We actually see it in our data. More and more people, they want to buy local. They are willing to pay a little bit more for local. The problem is that they're not necessarily looking for it, and they may not even know what it means. And I think when I think about wineries and beer makers in our country, I think there's a role there to play about celebrating what we do here in the country, what we do as a sector, because I think a lot of consumers will value what is going on, will understand the supply chain, and will be preoccupied by where you get your ingredients, how you make your beer or wine, who are you employing and whatnot. That's why Stella Artois and Corona, for the first time ever, they will want to brew in Canada. Kraft Heinz last week, they've announced that they're building a $21 million plant in Montreal to manufacture their ketchup for the first time in many years. All these things are going on right now. Why? Because we all know that more and more economic nationalism, pushed by the Trump administration, of course, and will continue to be pushed by the Biden-Harris administration, as far as I'm concerned, that's going to have a huge impact on how people see food overall. And I want to make one last point about how food is being socialized right now as a result of COVID. I actually do think that there's a bit of a different social contract being established between the food industry, beverage, and consumers. And I think it's going to be long lasting. I'm not saying that everyone will be buying food differently, but there is a new social contract emerging as a result of COVID, which actually I think will bring more opportunities, not less, for the winery industry and brew industry as well in Canada. So on that note, I'm just looking at the time here, and we still have Greg, who needs to say a few words. Back to you, Sandra.
All right, thanks so much. That was great, Savan. Let me see, we got Greg. There we go. All right, so our last speaker is Greg Classen. He was both the Chief Marketing Officer and CEO at Destination Canada. And during his tenure there, Greg and his team developed Canada's tourism brand, bringing it from the 12th position worldwide to #1, yay, and recognition of Canada as the most recommended destination in the world to visit. Today, he's a partner at 2031, where he advises global tourism industry through leveraging disruptive forces. And we certainly have had disruptive forces. So welcome, Greg, and we're really happy to have you on today.
That's great. Thanks very much, Sandra. Really, it's fascinating conversation so far. And I'm full agreement, I think, with the previous two speakers, Sylvain and Camille, talking a lot about the pivot that's happening in takeout. One of the challenges that we face, of course, in tourism is that tourism can't pivot to takeout. We need those visitors and we need those border crossers to come to Canada. And it's had a fairly devastating impact on tourism, of course, for our country, not just for our country, for the world. But I do have some bright lights and some opportunities as I get through my presentation to give us something to wait for, or perhaps even hope for. The very first thing that I talk about when I give presentations about tourism is that there's always that question is, when do we see the light at the end of the tunnel? What is the light going to look like at the end of that tunnel? And of course, this past couple of weeks, we've seen some glimmers of hope with new vaccines and opportunities for distribution of those vaccines. But I really reframe that question, and it's not about the light at the end of the tunnel necessarily, but it's just a recognition that where you come out is a different place than where you go into a tunnel itself. And so it's important to note that our industry, I think much like the hospitality industry and the food and beverage industry, we've seen some fairly fundamental and profound change that's happening. And that change isn't going to stop. Those accelerated changes, like in your industries, will continue to move at a fairly rapid pace. So we'll talk a little bit about what those changes look like. First thing, though, is that we look at the significance and the decline of tourism. I think, as Sandra pointed out, I've been involved in tourism mostly with Destination Canada, but as a tourism strategist working with destinations around the world for the last 25 years in total. And I've worked through all of these challenges and these crises that we've engaged in: 2003, 9/11, 2009 global economic crisis. But this chart really shows off exactly how profound the crisis is happening in the business of tourism right now. We panicked in 2003 and we panicked in 2009, and we thought it was the end of tourism. But just look at the significance of the decline that we're facing now in tourism going forward. We also know that that tourism was on a very, very fast trajectory. 2019 was global tourism's best year ever. We were heading very, very quickly towards doubling of international tourism revenue from 1 billion international tourism visits in 2012 to 2 billion international tourism visits. And again, when I say it took us 1,000 years for that first billion, it was only going to take us 30 years for that next billion. And we do know that that tourism will continue, that there will be a shift and there will be a recovery in tourism, but perhaps we're calling it more like a renewal in tourism going forward, and we still believe that we'll make those trajectories. So what are the greatest barriers to tourism? And I'm going to argue as something that that I find more aware and more acute. The greatest barrier to return of tourism isn't necessarily COVID itself, but it really is the fear of travel. And I think Savan talked about confidence right now that's going on in terms of the hospitality industry and the food-based industry. We see a significant barrier to return to tourism through confidence. And that's the loss in confidence in total travel. That's a fear of travelers with coming and visiting into our community. We see a significant confusion over the rules and regulations allowing us to travel or not travel, or travel but don't travel, or travel but bring your own food if you travel. Don't visit those communities but go see people. We're very, very confused about those rules around travel. And ultimately, we'll demonstrate where there's just a simple loss in the joy of travel. We've just lost that in the last 8 months, and those are things that we believe strongly that we'll need to recover going forward. So this is from Destination Canada, that has looked at what some of the sort of behavioral changes that in fact are impacting travelers. And a traveler who was once adventurous and relaxed is really now very, very uncertain. And prior to COVID, we saw travelers describing themselves under normal circumstances as really relaxed and adventurous and seeking opportunities for themselves and their family, and pretty excited in general. What we see now in a post-COVID and during COVID and as we get into a post-COVID world, we see a lot of anxiety. We see people are nervous, they're worried, they're uncertain, they're reluctant. They're just not sure what that future looks like, and tourism needs a lot of certainty in order for it to thrive going forward. And again, towards the end of the presentation, I'll talk a little bit about what our recommendations are to help support that. The second one is the fear of travelers in general, and the fear of travelers is really, this is the BC fear. Only 7% of British Columbians are actually open to welcoming people from either the US or the rest of the world. And really a small percentage, only 35%, are open to welcoming visitors from other parts of Canada. And we saw a fair bit of this summer. I saw a number of social blogs saying, I saw somebody from Alberta Plates and they shouldn't be here and they've stopped. And we saw those articles in the newspaper about those driving through to Alaska, stopping in on the way, having dinner, having lunch, and being from abroad. That's the fear of travel, or the sentiment towards welcoming of visitors is a fairly significant deterrent for the visitor experience and the people wanting and considering to enjoy our country. Also, the fear of travel in general. Deloitte comes out with a study. They do this every month globally to determine what that sort of interest in a number of consumer-based categories. Only 27% of the world feels safe flying right now. Only 36% of the world feels safe staying in a hotel, and only about 1 in 4 prospective travelers are interested in planning a trip over the next 3 months. These are very significant declines from pre-COVID levels, where it was virtually almost 100% people willing to get on a plane and stay in a hotel. And if we think we're any better in Canada, we're 100% wrong, because we are the worst of 15 countries surveyed. Canada has the lowest levels of those feeling confident about traveling. Only 19% of Canadians feel safe flying versus 27% for the rest of the world. Only 19% feel safe in a hotel. That's 1 in 5 previous Canadian travelers, and only 17% of those travelers are actually planning a trip in Canada. So we have a confidence problem in Canada, and we have a nervousness problem about visiting other places. Finally, travel is simply not interesting to COVID. This comes from an organization called, gosh, I can't see my screen here, Focusrite. Focusrite does a lot of surveying and research in the tourism industry, and they identified that it wasn't necessarily COVID or financial considerations in almost all markets. The blue here is reflective of the idea that people simply don't want to travel due to COVID restrictions. Simply saying that what's the point of traveling if I still have to stand in lineups, if I still have to be 6 feet apart, if I still have to wear a mask, if I still have to be nervous when I'm outside about COVID, and effectively just taking themselves out of travel. The joy of travel has really been dissipated. So if tourism is looking to develop, what we're suggesting is that tourism is looking to 2019 to develop its 2021 strategy. It really is looking in the wrong direction. There are some glimmers and some clues about our tourism strategies in 2019, but we are seeing some wholesale changes, as we are seeing in the food and beverage industry. Some of those accelerants that were created prior to COVID will continue to accelerate in going forward with COVID. We see that only about 30% of travelers or potential travelers will even consider traveling in the coming 3 months or into next year. We also know that so many destinations that have been decimated in terms of travel visitation will be marketing to too few travelers going forward. And those destinations and those operators and experience providers will absolutely have to shift to provide confidence to travelers and communicate their brands in whole new ways. So how do we address these issues? The first one is to help Canadians feel safe to travel again. Communicate with governments and health authorities to reduce the ambiguity of messages and the evidence for decision making. We say that only 17% of Canadians are willing to get on an airplane, and yet there's not a single case of COVID transmission on an airplane in Canada. It turns out that airplanes are very, very poor transmitters of COVID, and in fact, Dr. Theresa Tam herself said that airplane flying is very safe. In fact, the airports are slightly less safe unless you're taking all the reasonable precautions. A Harvard case study also supports Dr. Tam's views about the safety of flying. Yet this weekend, I opened up the Vancouver Sun and there was a whole front page article about how many cases of COVID were found on airplanes themselves. So again, while there's no transmission of COVID on airplanes, we're constantly seeing these articles to suggest that that airplanes themselves are petri dishes to get COVID. And those are challenges that we need. We also need more rapid testing at airports, messaging about their risk, and better supports for the tourism and hospitality industry. We know that we're testing right now at the Calgary airport. We know that we're testing in Toronto as well as Vancouver, but those tests simply are not going fast enough. We see destinations around the world that are accelerating their rapid testing and focusing on recovery of their tourism industry on a much faster basis than we here in Canada. And finally, looking at rethinking our tourism or hospitality brands themselves. And I'll show you a few slides about perceptions of worldwide travelers, considerations for brands and the types of brands that they want to support into the future. And frankly, if we can do this, sorry, I'm going to the back one. And if we can do this differently and we can do this correctly, we will get a better outcome. So I talked a little bit about the changing values of brands right now. And again, all brands are being reviewed and looked at very, very carefully. And this study comes, again, I'm from Edelman Trust Barometer, and this just came out a few weeks ago. And they talk about evaluating the shifts in brands and what's important to consumers when they review and look at brands where they consider buying. The first one is that a whopping increase of 31 points is that people are considering and looking more importantly at brands that put consumer safety first, communicating how your experience and how your restaurant and how your store and how your airport supports community safety first. Gives value for money, which is important, but more important now as we have some economic uncertainty going forward, and that brands that demonstrate that they care more about people than they care about profit. Now, when we consider previous brands, most of the time brands are really focused on how they make people feel, whether they can be, cool if they're wearing this brand or driving this brand, and that kinds of things. And those things have gone way, way down. It's less about people leveraging the brand experience that they have in order for them to look cooler, and it's more about perceptions of safety and keeping them safe. So some possibilities in terms of our own restaurants and our own hotels and facilities. Again, looking at Canada itself is an outlier here a little bit compared to other destinations. Global average of 8 destinations says that 61% of brands should think about public safety first. In Canada, we believe that number should be higher at 68%. Again, just talking about the carefulness of Canadians relative to other regions around the world, our relative ability to manage this crisis, but has really created a lot of fear and a lot of anxiety and a lot of more comfort in brands themselves that are likely to meet these criteria. So what opportunities do we have for tourism renewal for Canada's recovery, and how will we emerge ahead of our international competitors? I believe that we will, for one, because of our reliance on the domestic market. Over 80% of Canada's tourism industry depends on Canadians traveling within Canada. We've always tried to improve the number of international visitors to Canada. And as I said, we had a record year last year, but 80% of Canadian tourism will help us recover our market. In fact, of all the countries in the world that rely on tourism, we are the 6th most reliant on our domestic market, which should help significantly increase our improved recovery, especially when things like Atlantic bubbles open up or other bubbles that have impeded the ability of Canadians to travel within Canada itself. The second is Canada's brand itself. There are a number of different surveys out there that determine Canada's brand, but the most recent one that came out, which is the Anhold GMI Index, supported the idea that Canada now has the 3rd best brand in the world. In the past on that particular index, I think that's our highest ranking yet. So Canada is perceived around the world to have a very, very strong brand against a number of different kinds of criteria, and that brand itself will serve us very well going forward. The third is that Canada sits within the top 5 countries that global citizens would be the most comfortable visiting in the next 5 years. Survey done by an organization called Destination Analysts suggests that we are in 3 of the top 5 countries most comfortable visiting in the next 5 years, and that and the next 3 net positive rating for our ability to have managed in a health crisis and our general perception of our healthcare system itself. Now, this is in stark contrast because the US is the #1 country that people will not want to visit in the next 5 years. And of course, the US is one of our #1 competitors out there. So we do have opportunities for us to stand out among the crowd in terms of what our future is going to look like. So finally, some tourism trends in terms of going forward. We talked a lot about food and beverage being local. We talked about craft. Those same things will happen in tourism. Localism and domestic tourism will grow. We'll have small communities and resorts that are already demonstrating significant growth this past summer. Resort communities were sold out. The Okanagan was doing very well. Tofino in British Columbia was doing very well. These places will continue to grow. People will seek out a little bit off the beaten track destinations. They'll seek resort locations. They'll seek wide open spaces and fresh air. We know that 38% based on tourism trends will go to rural and remote destinations that they may have not considered otherwise. And 17% more than prior to COVID are considering vacations near national parks themselves. The second trend will be that the genie is out of the bottle. Most digital nomads, those people that used to go in from Monday to Friday into their offices, are now at home, working at home and working very effectively at home. We've seen a number of organizations that have determined that they are going to shutter their offices and they're going to allow their people to continue to work from home because they've seen how effective it has been for their employees. But these employees with the ability, with their computers and their Wi-Fi, can work from anywhere they happen to be. So we're going to see some traditional changes in terms of how they can travel. They may go to Portugal for 2 months and work from there as long as they have access to Wi-Fi. They may go to Kelowna for a month in the winter time so that they can ski and work from there at the same time. So we'll see a number of destinations. We'll have opportunities to attract people coming for longer periods of time who plan to work from those locations and have new experiences while they're there. We know that because of that, the shoulder and winter season, which has generally been the bane of our existence here in Canada and many other destinations around the world, will see more growth and more opportunity, particularly this year, as Canadians themselves will generally and typically go south for a portion of the winter, will decide instead to come to different parts of Canada and hunker down and have some type of getting out of the house kind of experiences when lockdown will allow them to do so. But that will only happen again if businesses stay open. We have a number of hotels, a number of experiences that simply close after the October long weekend and don't open again until the spring. And these things will need to stay open in order to support this customer base. And finally, we'll see a lot of those digital teams, small teams that will take place in real life with virtual workforces and resort destinations with incentive style and team building events. If those digital workers and digital nomads can't get together from Monday to Friday, they will get together every couple of months, and they'll want to get together where they can have meaningful meetings with their cohorts, the accounting team, the human resources team, the marketing team, groups of maybe 10 to 20 people in smaller locations, smaller venues, where they can combine that with some team building exercises, team building experiences, some great meals, and some great wine in some hotels and resorts around the world. So opportunity again to grow tourism, to support the small meeting style for those teams that aren't typically getting together. So that's it. That's the trends that we see. That's the challenges that we see ahead. We do know that there's consumer confidence out there. We know that tourism simply can't pivot to takeaway. We know that there's significant challenges ahead with tourism, but there are some small glimmers of hope for both Canada as well as for a transition in terms of how we manage tourism going forward and how we adapt to the new tourism realities. So thank you very much.
All right, thanks so much, Greg. We're going to take some questions here. We're just right at the end of the hour, but I've been writing them down. So hopefully if we can get everybody back on video and unmuted. I'm going to start off with JP. If you could please bring up your, just grab the screen share and bring up those slides that you had on food trends. There we go. And all of a sudden, there we go.
I believe that's the one.
I think that's it. So yeah, Rhonda was just looking at, yeah, if you could just cover that just briefly again.
Well, yeah, because there's lots to talk about, right? So one of the things that we track is month-to-month manufacturing shipments. You can do that by province. This is Stats Canada data. The really interesting thing is that Stats Canada is moving to more and more advanced estimates, or advanced release. So you're not waiting to compute all the data before releasing anything. They just did that this morning for manufacturing, not by sector. So you won't be able to get an advanced estimate or in real time, which is called nowcasting. So more and more you see a lot of financial institutions like ourselves moving in terms of nowcasting, the idea that you don't have to wait, get the data, compute everything, release. So maybe a little bit later on, you'll see StatsCan being able to release a little bit more at the industry level. So this is based off industry level data. If anybody, I'll put my Twitter handle in the chat box there as well, because that's something easy for me to share on Twitter as well. You can grab and look for yourself and take the time in, as opposed to a meeting like this where it's go in terms of timelines and making sure that everybody can fit in the material, right? So I know Sylvain is pretty adept at social media as well, so we can all put our Twitter handle in the chat box and invite people to go and see. But really, it's the idea that there's been quite a rebound for wineries, which has coincided with what everybody has discussed. But on the brewery side, it's been a bit more difficult as well because of the March and April numbers. But fantastic summer for sure.
So while I have you on here, JP, can you talk just briefly about what you think is going to happen if people are building, like the price of lumber, steel, that type of thing, and how that's going to be impacted?
Yeah, so full disclosure, we don't monitor, we don't provide an outlook for steel, but certainly lumber is an area where we monitor quite carefully. And I do think that, yeah, we've seen prices come down, but we do expect for a number of years, I'm even tempted to say that lumber prices are going to remain above the 5-year average. Construction costs are not going to be coming down easily. Labor issues, there's all sorts of factors that actually point towards construction costs being elevated for a period of time. So a number of clients I know are asking themselves, well, should we wait? What should we do exactly? And I rather say that, I think the proper assumptions to work with right now is that construction costs are going to remain elevated for a number of years.
Great. Camille, what are the medium prospects for the wine and liquor industry? Or, the general question from Al was whether or not we're going to be heading back into a recession, but more specifically on prospects for the wine and liquor industry in the medium term. Oops, sorry. There you go.
There
Now
we go.
got
Thank you. It happens to me at home all the time. Well, I guess, so I think the first was kind of medium-term prospects on the wine industry. I think the first is it's an industry that has been growing very kind of consistently and compounded beautifully over 2 generations. Many of those share gains have come from beer. Those share gains kind of leveled off in many ways about 5 to 7 years ago, but we didn't really feel it in the same way. We've now gone from, and this is a typical curve that we see in CPG, things happen slowly. So many years of gaining share, many years of flat. Now you've had 1 year of negative. And I think for wine, we have to be very careful that that's not the beginning of what ends up being 5 to 10 years of slow market share gains. It's not going to be dramatic in the sense that it's not going to fall off of a cliff and just be a kind of catastrophe. But what happens in CPG typically is things just compound themselves up or compound themselves down. And the share gains of beer going from 60 to 45 also went from 45 to 60 the 2 decades prior to that until 2000. And so it's very reasonable to think, based strictly on how these things have generally evolved, and we can get into the consumer reasons why, that wine could go into a longer period of losing market share kind of year on year to beer and spirits. Now there's ways to kind of address that, obviously, and everybody will make an effort, but again, the way that we typically see these trends, it's likely to be what happens.
Okay, Sylvain, from Kathy, what do you mean about food being socialized differently and the opportunities that it presents? Can you elaborate on this a bit? Oops, hang on, sorry. My bad.
All right, thank you. I actually wrote a response you can read. I'm not sure who can see it. I think Kathy can see it, but essentially, I mean, context is a big deal. I mean, some food products have actually been penalized as a result of the fact that we can't socialize out of household. Like poutine, for example, I go back to the example of poutine because poutine is a inherently socialized dish, really. I mean, you will eat poutine often with someone else, with a beverage, with a few beverages, in fact. And so it's highly, and I would say that the same rule applies to wine and beer. These are really socialized food products or beverages. And the beauty of wine and beer is that they're highly portable and flexible. You can actually recreate some sort of situation at home or anywhere in a park, at the ocean, on a beach. And so there's a lot of power there from a social perspective that you need to consider as you think about the future of the market. That's what I meant by socialized, how we socialize food.
Great. And lastly, just real quick for JPA, again, I think you answered this, but what kind of tax measures do you expect that the government might put in place to raise revenues?
I did say that I believe it's a little too early to be, going into the specifics. I'd be surprised if the federal government is thought about long and hard about what they'll be considering, frankly. But, I don't think anything is off the table. I do think that there is going to be maybe a little bit more of a progressive tax schedule for households and businesses, and as well as, some very specific measures, whether it's capital tax exemptions or, like I said, I do think that at this stage, I would certainly think that everything is on the table.
Okay. Okay, well, I'd like to thank the panel for being on. I really appreciate it. We learned a lot today, and I hope you are well going into the winter. I'd like to remind the attendees that we'll be back here at 11 with the breakout sessions, and also during the break, make sure you visit the people in the trade show. They're all standing by waiting to get your information. So yeah, so enjoy, and we'll see you back here at 11.
Thank you.
Everybody.
Bye-bye.
Bye.